Hello and good evening to everybody. I am Cheree, the Money Lady. Wanted to welcome everyone here this evening. Tonight's conversation is all about um, buying your first investment property and what that's going to look like. I am going to talk a little bit this evening with regards to some of the options that you have, some of the strategy you want to think about, some of the um, hiccups that I've seen people have, and just kind of give you a general guidance of uh, what it takes to purchase and get that first investment property funded. The other thing I want to say is every Monday at 5 p.m., we are going to be doing these kinds of webinars. I'm going to be doing all sorts of stuff here with regards to inviting guests to come on to talk about either their deals that they're working on and how they're getting funding for their deals and things like that. Or I'm going to showcase some case studies and we're going to kind of dig into the numbers and all sorts of information is going to be given during these sessions. So if you want to mark Mondays at 5 p.m. Eastern time off on your calendar, I'd love to have you every week because we're going to switch it up and that way you can continuously come and continuously learn more information with regards to getting your deals funded. So, I am Cheree. I am the money lady. That is what my team calls me. And I work really hard to help my clients actually get the funding that they are looking for. So, uh, what I'm going to do today is actually share my screen and share a little presentation that I have. Let me just get this fully set up here. And then we're going to get started with just some basic information this evening. The other thing I will say is once a month, I'm going to be doing this general presentation as well. So if you have any family or friends or coworkers that just want the basics, then they'll be able to come here, hear information, and also get their questions answered as well. So tonight's session is all about show me the money, getting funding for your real estate deals. And you can see my license number down here because I actually help people buy homes for themselves. I'm licensed in 7 states. So you can buy a home for yourself or you could buy investment property. And we have ways of helping you do that nationwide. So the agenda for this evening got a little fun here. We're going to do myth or fact, true or false. We're going to talk about some of the loans that are available for you for investment properties. We're going to talk about some low down payment options because I always get people asking about that. And then we will open it up for questions and answers. So who am I? I'm Cheree, the money lady. I'm a lender that actually specializes in working with investment-minded people. I help you build wealth, and I am a wealth builder myself. And I live in a small town in Maryland, upstate Maryland, that you probably never heard of before, with my two German shepherds and my mom. So, but with regards to me being a lender, as I said, I am licensed in Maryland, DC, Virginia, West Virginia, North Carolina, Ohio, Tennessee, Florida. Um, yeah, and those are all the states, right? But if you're looking to buy investment property nationwide, let me know. If you live in another state and I cannot personally help you, I will send you to a trusted individual who would be able to assist you as well, because I have a huge network of trusted loan officers that I will make sure that you're in very good hands. So, uh, I also am very, very passionate about helping people build wealth. So the first thing is, helping people just understand that when you make money, there's a certain portion of money that goes to you building wealth through real estate. And that money can come through cash flow. It can also come through appreciation. And some people will say, well, I want both. And that's totally understandable as well. My boss has something called the income flip. So work with a gentleman named Rob Chavez, and he has something called the income flip that he really teaches to people, which is all about, let's say you make $60,000 a year today, right? How could you set yourself up with a different cash flowing properties in order for you to have more passive income than active income, or to have your passive income? And really, real estate is not fully passive, it is semi active, as I call it, but how to have that income pay for your basic bills, right? So when I'm working with individuals, I don't just think of, you know, how are you going to do this one property? What I do is I really focus on what kind of a portfolio do you want to build, and how can I help you achieve that? How can I help you actually build that portfolio in a way that makes sense, in a way where the property you're buying today doesn't jeopardize the property you want to buy 2 years from now, things like that. Um, yeah. So myth versus fact. Question number one, and you can put the answers in the chat if you want to participate. Question number one, true or false? You need 20% down payment to invest in real estate. Do you think this is true, or do you think this is false? And we got something in the chat here saying true. The answer is it depends. It depends. It can actually be as little as 0% down. And I'm going to talk to you a little bit this evening. And this is not like creative finance, right? I'm going to actually talk to you about ways where you are able to purchase a property and have it be a part of your real estate portfolio with 0% down, 3% down, 5% down. Okay. But let's then move on to question number two. The best first investment property that you can have is a rental. True or false? The best first investment property you can have is a rental. That is false. Thank you so much for participating. That is false. The best first investment property you're going to have is your primary home, because your primary home is usually the foundation that you have in order to purchase other properties. So we want to make sure we get that primary home purchase right. So, true or false? If the deal makes me money, I will definitely qualify for the loan. True or false? As long as the deal makes money, I will definitely qualify for the loan. You are right, everybody. It is false. There are more things that go into you qualifying for the loan. Number one thing is credit score. Number two, depending on the kind of loan we're getting, is you may have, let's say, a 650 credit score, but if you have been late on your mortgage recently and things like that, depending on the loan that we're getting, sometimes that can cause you to be denied. So we want to be honest about those things as well. So yeah, credit score, you could have a down payment issue with regards to you don't have enough money, right? The third thing that I see really tripping people up is where you're buying your properties. There are lenders and there are certain kinds of loans where if you're buying in a rural or a remote area, they will say no, or they will have you put down a huge down payment for you to get into that house. And this could be for an investment property, more so an investment property, like if you're buying it truly as an investment property. So, true or false? We can buy deals with no money down. True or false? We can buy deals with no money down. True. Okay. This is actually a trick question. Because the super, super, super majority of the time, I'm talking about 99.9% of the time, you're going to have some money in the deal. Now, it doesn't necessarily have to be your money. I know people who they find the deal and somebody else is the money partner. That happens all the time. Also, you may buy a deal through creative finance, but you may have to give that person, let's say, 20, 30, $40,000 for them to give you the keys. They call it cash for keys. Or you may get it like the person says, here, just take the property and I just want to leave, right? Oftentimes with people like that, those motivated sellers, you still have to go in and clean the property out. They may leave a whole lot of stuff there. You have to make repairs, So 99.9% of the time, somebody's going to put some money into these deals, right? It's very hard for people to get a deal where there's absolutely no money involved, no money either from them or from their money partner involved. So, next question, true or false? If I get pre-approved, I'm good to go. I got my pre-approval from my lender and they said I can go shopping. I'm good to go. If I get pre-approved, I'm good to go. The answer is false. It is false. It does depend on the lender because sometimes some people will give you a pre-approval and it's not worth the paper it's printed on. So they didn't get anything confirming your credit. They didn't do a credit pull for you, a credit review. I will tell you that depending on a couple of circumstances, we will do a soft credit pull so we can at least make sure that the credit is in line. I will tell you that, and this has happened in the last couple of weeks specifically with a few of my clients, is that they will go on their banking app and they'll get one credit score. I had true story. I had a client that had a 764 when she tapped into her bank. Yet when we did the official credit poll, her credit score was 741. Okay. She wasn't too happy about that. But what happens is the credit score on your banking app is a different type of credit score than the one we actually pull as mortgage lenders. So that's just because there are about 7 or 8 different types of credit scores. So if you want to Google that, right? But a pre-approval doesn't necessarily mean you're going to get approved. So it's very frustrating for some people when they are getting in the process of getting pre-approved. If you have a lender who is asking you a lot of questions and asking for certain pieces of information. But the truth is, depending on what kind of loan you're looking for, the more information the lender is getting upfront, the less chance that pre-approval is it is going to fail you. When it comes to you putting an offer on a property, it's accepted, you're ready to go, you're ready to close, and then they're like, wait. Sorry, we actually can't do this loan for you. So the next question, true or false? I can just refinance when I'm done with my rehab. So you want to BRRRR, right? You want to buy, renovate, rent, refinance, and repeat, right? And you get to the refinance part. You took that 12-month loan, you get to that refinance part, and you're just like, hey, I can just refinance when I'm done with the rehab. The answer is false. It is false. I have had situations where people's credit take a dip, for example, and they either cannot refinance or this happens actually much more often. They can refinance, but they have to bring more money to the closing table in order to refinance. Cannot tell you how much that happens. I'm working on 3 right now where they got this fix and flip loan because the fix and flip loans have a little bit more room and space, but they wanted to keep the property and nobody actually did the step of the process where we look to make sure that you would be able to refinance out of that 12-month hard money loan. So I just want to warn people about it. In fact, when you work with us, because I won't say if, I'll say when you work with us and you tell me you're going to burr that property, I'm going to actually do the calculations, or my assistant and I, her name is Ariane, she's fabulous. Ariane and I are going to do the calculations to make sure you can refinance out of that property. And in fact, I helped somebody not make a $50,000 mistake because she wanted to buy this house, she was going to renovate it, and then she was going to refinance out of it. And even though I could have gotten her into that 12-month loan to buy and renovate the property, she would have had to bring another $50,000 to the closing table when she was ready to refi. So just be careful about these things. Next question, true or false? All lenders are the same. Just find the lowest rate. True or false? You're a lender, I'm a lender, she's a lender, he's a lender. I go into my bank, whatever big bank you're a part of. That rate, all of them are just the same. Just find the lowest rate. The answer is false. False. All lenders are not the same. All pre-approvals are not the same, and all lenders are not the same. Finding the lowest rate means nothing if that person cannot close that loan. Or if they're not available on the weekends, if they're not available in the evenings, if you put an offer on a property and that lender, that person that you're working with, doesn't call that listing agent and say, hey, I just want to let you know, I looked through Jane's financial information. She's good to go. I will tell you that true story. One Saturday evening, 6 p.m., a listing agent called me and she said, the only reason I'm selecting your client to buy this house is because you picked up the phone on a Saturday evening at 6 p.m., right? So it's not just about finding the lowest rate. It is about finding somebody who can also get you to the closing table. Next thing, true or false? It's fine to work with any lender as long as they say they can close the loan. As long as they say, like, hey, of course I can do this deal for you. I can give you a 6.5% rate. Come work with me. I've actually seen this before. It is false. It is false. Just because they say they can close the loan doesn't actually mean that they can. One of the things that we do is we work with a lot of investors. We do broker certain loans out, but here's the thing. If I quote you and if I say I'm going to bring you to this specific lender, it is only because either one, I have closed loans with that specific lender before, so I know that they can close the loan. Or number two, somebody who is a fellow loan officer that I trust has personally closed the loan with that person. And I know that through my relationship with that loan officer, that that lending company can actually close the loan. Here's what happens a lot. We as loan officers get all sorts of emails and phone calls. Try our fly-by-night lending company. We will give your buyers the best rates and the best, the lowest fees and all of that. And I have had it happen to me before. I only let it happen once. And I said, never again, where I brought somebody to a lending company who was not fully vetted. And at the 11th hour, they said, oops, sorry, we can't close this loan. So you want to actually know what that person's process is for actually vetting the company that's ultimately going to be funding your loan, especially if you're working with a broker. And I'll say this as well for a bank. Let's say you're doing an investment property and you go to Bank of America, Wells Fargo, whatever bank you're going to, you know, uh, just because they say they can fund that loan for you doesn't necessarily mean that they can. There are certain loans that they do and a lot of other loans that they do not do. And if you don't fit into certain boxes, then you're not going to, they cannot be creative if and when the time calls for it. So tonight, we're going to talk about a few different ways that you are able to actually build your portfolio. We're going to talk about house hacking. And there's a reason we're going to talk about house hacking is because a lot of first-time investors or younger people will choose house hacking as the way for them to actually buy a home and get some cash flow, based on the home that they are purchasing with a low down payment. So next, we're going to look at fix and flip. So I'm going to talk to you a little bit about that. We're going to look at properties you want to fix and then rent. We're going to look at some rental property loans that you're able to use. And then again, we're going to look at some low down payment options as well. So first thing is house hacking. House hacking is really great. And you can do house hacking in a couple of different ways. For example, I live with my mom or she lives with me. I bought this house. She decided she wanted to come live with me and we do house hack in a way. So instead of me having the entire burden of everything, all the bills of the house, we are able to split those bills, right? So multi-generational living, where maybe it is mom or dad or your sister or cousin or niece or nephew or your friend or well, it may not be best to mix business with friendship, but or you may choose to buy a duplex or a triplex or a fourplex. You could buy up to 4 units and be able to get your property for as little as I have here 3% down, but depending on where you're buying, you might be able to even get a USDA loan for zero down, right? Most people, though, can do as little as 3% down if you're a first time home buyer or if you fit certain um, income standards, then you can get in for as little as 3% down. You can get in for as little as a 580 credit score. I will say for my people who have lower credit scores that, and this is not Cheree or Cheree's company, this is like a federal agency thing through Fannie Mae and Freddie Mac. Sometimes if you have like a 580 credit score, but you have a lot of recent lates and things like that, like a lot of them, it will still kick out your approval. So I don't want you just to rely on the credit score itself, but also like how long it's been since you have missed any payments and things like that. I don't want to scare you. Am more than happy to review your credit report with you. And then we have a credit guy named Credit Ryan, who I have two of my clients there with him. They love him. He does great work with regards to strategically helping you increase your credit in order for you to buy a home. So we can look at the credit score. We're going to look at your down payment. It's really great, again, for first-time home buyers. And you can even, with something called the home style renovation loan, You're even able to buy a property that's a fixer-upper. You can buy it and renovate it and have it all as part of one loan, right? So I was talking to somebody about this earlier today. You can tear down walls, build walls. You can fix the bathroom, fix the kitchen, fix the roof, all sorts of things you're able to do with that home style renovation loan. You can even turn a 1 unit into a 2 unit. I do suggest that you get your permits, and all of that is actually going to be required as part of the loan for you to work with a licensed general contractor and get the permits you need and things like that. But that could be a great way for you to turn a 1 unit house into a little small 2 unit house, or you can rent the basement and live at the top, or you can live in the basement to rent out the top of the portion of the house, or all sorts of stuff like that with regards to house hacking. So house hacking is a great way for people to kind of get started with the real estate investing process. All right, number two, fix and flip loans. A lot of people want to do fix and flips, okay? Fix and flips are a great way for you to earn income, right? So it's not really for cash flow or wealth building, but it is a way for you to get cash. All right. So the fix and flip loans are anywhere from 6 months to 12 months. They usually require a 660 credit score or higher. You're going to put down anywhere from 15% to 35%, even though now I actually have a source where you could put no money down depending on the deal. So no down payment, I should say, depending on the deal. Okay. Usually a lot of the lenders will pay up to 80% of the purchase price, or give you up to 80% of the purchase price and 100% of the construction cost. But again, I have a source now, depending on several factors, that may be able to give you 100% of the purchase price and construction costs. So it'll really depend. And this is, again, a well-vetted source that we trust, that we've actually, people in our network have worked with, that we trust. So these specific loans you can close in 10 to 30 days. And I will say that the more experience you have, the better the terms are going to be with doing fix and flip loans. Your first fix and flip loan is really just about you getting the experience. I see we have a question here. Oh, Charlene is saying very popular. Okay, you're talking about the fix and flips. Yeah, they are very popular. Yep, they are. So the other thing you can do with the fix and flips is you can have a partner with experience work with you for the first couple of fix and flips that you're doing as well. And you may be the money person, and that person may be the experienced person on the loan, and on the property. So you won't get the benefit of them helping you with regards to terms unless they're willing to be a guarantor on the loan. But if you do at least 2 fix and flips, and you decide to do them with somebody who has experience, and one of the things that you'll do as you start to get more and more experience is that people will ask you for something called an experience worksheet. And they will ask you, like, what was the address of the property? What did you purchase it for? What was the rental cost? How much money did you make? So the more that people can see that you have a track record of making money with the fix and flips, the better off you're going to be. So, but you can do them solo if you want to. So here's a quick example. Let's say that you are going to buy this property for $70,000. You're going to renovate it for $10,000. The after renovation value, or ARV, is going to be $100,000, right? So you're going to have $80,000 into it to buy and renovate it, and it's going to be worth $100,000 after you have finished the renovation. So the lender could offer anywhere from could ask you to put down anywhere from 10% to 35% of the purchase price. So you could be looking at anywhere from 7,000 to 25,000. And you may say, well, Cheree, what's the difference? Two things, actually three things: your experience, your credit score, and the location of the deal. The location of the deal is it a rural property or is it in a city or a suburb? Credit is your credit a 660 or a 760? Experience is this your first one or is this your 10th fix and flip, right? So a lot of that explains the differences. The lender's going to pay 100% of the renovations. And what they usually do is you get started on the renovations and then you do something called a draw request because you're going to do something called a construction draw. So let's say your renovation is $10,000 and you're going to break it up into 4 draws of $2,500 each, right? Obviously, you would never choose something that low in real life, but this is just to explain this to you. So you would do $2,500 worth of renovations. You would complete a form for the lender and say, hey, I've done $2,500 worth of renovations. They will tell you how you prove you've done those renovations. So oftentimes, if it's just like light work that needs to be done, carpet, paint, appliances, then you'll be able to take pictures or video. If it's like heavy types of renovation that needs to be done, you know, the roof or like, hot water heater, septic, things like that, they may have to send out an inspector. But they will do that. They'll confirm that you've done $2,500 worth of renovations, and then they will give you the $2,500. They will put that in your bank account. And then, you're going to do the same thing for the second request, the third request, and the fourth request. It's that same cycle of your contractor or you does more work. You submit the information to the lender. They confirm that the renovations have been done to whatever point you say it has been done, and then you get your money. Okay. These are going to be interest-only payments. So you'll pay interest. There are some lenders who will just have you pay interest on the amount of money that you have taken out. So, the amount of money you took out at the closing table in order to purchase the property. And then as you're renovating, they will begin to charge you more and more interest based on the draws that you're doing. Okay. Most lenders are like that, right? The final thing is there are no prepayment penalties with these kinds of loans. So if you want to pay back in 3 months, you can. If you want to use the whole year, you can do that. And I will tell you that one of my clients had to file an extension because she needed another 3 months in order to tackle some things with her credit so that she could refinance. So when you get the loan within the contract that you're signing, there's usually something that says, if you need to extend this loan another 3 months or another 6 months, it's going to cost you X number of points. Usually, 1 point equals 1% of the loan. 1 point equals 1% of the loan. I have seen a lot of lenders charge 1 point for either a 3-month extension or a 6-month extension. So, but that's not for everybody. That's not all lenders, but you can just kind of be aware of what the rules are with regards to this. So, The next thing with the fix and rent. Sorry, fix and fix and rent. So you don't want to fix and flip. You want to actually burr, right? You want to get the property, you want to fix it up, and you want to rent it. And you may not just burr, you may not burr it. You may just, like I said, fix it up and rent it. Usually you're going to get a 12-month loan in order to buy and renovate that property. And then once it's renovated, you're going to refinance into a 30-year loan. Okay. And again, these are for investment loans. If you're going to live in the property, that home style renovation loan or the FHA 203K is going to be the better option for you. Actually, it's going to be the options for you. But if it's an investment property, then we're going to look at this as the way that you're going to fund your your ability to buy the property, rent it out, and then refinance into a 30-year loan. You can also fix the property up and refinance before you have a tenant in the property. Okay. With the refinances, usually the lender will assign an appraiser or ask an appraiser to come out and look at the property, and they're going to ask the appraiser to give them two pieces of information. The first thing is, what is the value of this property today after it's been renovated? The second thing they're going to ask the appraiser is, can you tell us what the market rental income is for this property? And based on those two items of information, along with your credit score and things like that, the lender will give you like a final offer with regards to how much they will give you for the refinance. So going back to that discussion that we had before, where you have $80,000 in the property with regards to the purchase price and renovation, and the property is now worth $100,000. Depending on several factors, the lender may say, okay, to refinance this property, we will give you $75,000 towards the refinance. Well, you'll say, but Cheree, I'm $80,000 into this thing. I owe that hard money lender $80,000, and the refinance company is only offering me $75,000. I will say yes. Therefore, you have to bring another $5,000 to the closing table plus closing costs. Okay. So these are the things that we do in advance to make sure that if you're going to have to bring money to the closing table when you're ready to refinance, that you are not shocked by that, that you're going to know in advance, okay, but I really want this property and I really see the cash flow and things like that. So that's my big warning sign, is make sure you can refinance. If it's important to you to refinance with no cash out of pocket, making sure you're working with me or whomever your lender is, preferably me, to make sure that you are going to be able to refinance with no cash out of pocket. And just know that before you buy the property. Okay. All right. Rental property loans. Let's say the property doesn't need any major repairs, or you're able to pay for the repairs out of pocket. You're going to get something called a DSCR loan. DSCR stands for debt service coverage ratio. Fancy term, simple concept. It means this: if the rental income can pay for the mortgage, and your credit scores usually has to be a 660 or above, then you're approved. I'll repeat that. As long as the rental income is high enough to pay for the mortgage and your credit score is like a 660 or higher, you're approved. Now, I do have one lender that goes down to a 600 credit. So you can come and talk to me about that. The lower your credit, though, the higher the rate is going to be. So the better your numbers have to be for this. A couple of things to note with regard to this. Mortgage payment includes your principal and interest, your taxes, your insurance, and any HOA and condo fees. So that rental income has to be able to pay for all of those things. The second thing is that you may have a lease on the property, or and the appraiser is also going to tell the lender in the appraisal what the market rent is for the property. The super majority of lenders are going to take whatever amount is less. Okay? Whatever amount is less. So just know that when you are, again, negotiating your deals and you want to get that DSCR loan. The other thing with regards to the DSCR loan is if you're buying a property in a rural area, you're going to have to put more money down than if you're buying a property in a city or a suburb. Just again, something to make a note of. Also, there are DSCR loans for short-term rental properties. So if you're buying a property and you intend for it to be a short-term rental, then there are loans out there that will look at the short-term rental income in order to get you approved for that mortgage. And these are regular 30-year fixed mortgages. So you get your mortgage and your rate is fixed. I don't like doing ARMs at all, adjustable rate mortgages. So you get something from me 99.99% of the time, it is fixed unless you specifically ask me about an ARM. All right. So, final thing, low down payment options, again, are for people who are going to live in the property. So, I need to change my slide here, but USDA loans are 0% down if you're going to live in a rural area. And some areas are designated rural, but they are kind of so close enough. Like where I live is designated rural, yet I'm like, I don't know, 10 minutes away from 95. So you could still be kind of close enough to things, right? And be designated as a rural area. Most places, if you're living in a city or a suburb, you're going to be at 3 to 5% down. Okay. You can get conventional loans, you can get FHA loans, you can get VA loans. I'm licensed for all of that. USDA, you can buy up to 4 units. So here's the interesting thing about this. Let's say that you want to buy a 4-unit building, you want to live in one of the units, and you want to rent out the other 3. What we do in your application is we look at the market rental income for the other 3 units. And when we are approving you, we add that expected rental income to your income. Here's a little bit of the caveat, okay? Is that we can include up to 75% of those other 3 units as rental income that's added to your income, okay? What that means is if you expect those 3 units to rent out for $1,000 each, then we can add $750 for each unit to your income. So that way you have a better chance of qualifying for the property. We can do that for a 3-unit or a 4-unit. If you're buying a 1 or 2 unit, even if you tell me, Cheree, I intend to rent out this property, we cannot count any of that rental income. All right. You have to be able to afford the property on your own for a 1 or 2 unit property. For a 3 or 4 unit property, we can include the other units that are being rented out as part of your rental income. Okay. The FICO here is 580 plus, so that's your credit score. And a lot of people do this for house hacking purposes. I know quite a few people that do this. And again, you can also use that home style renovation loan to turn a 1 unit into a 2 unit and things like that. So I'm the money lady, Cheree the money lady. You can also call or text us at this number. I'm going to leave this up while I give people a chance to ask any questions. You can either take yourself off mute or put it in the chat if you have any questions with regards to the things I talked about this evening. And I am looking on Facebook as well. Okay. I see a couple of people commented. Alonzo was here saying salute to us. So thank you so much to Alonzo. And saying here, good afternoon. Is there a scenario where an arm could be lucrative? Yes. Yes, there are scenarios. I don't know if lucrative would be the right term, but would be beneficial to you getting into the property. Yes. However, um, you have to feel very comfortable with what you're doing with an adjustable rate mortgage. Uh, I always say to people, know what you're doing with these things. So Charlene is saying, is it not a good idea to buy from other locations than where you live? So this is a great question. I have worked with a ton of investors, have spoken with a lot of people who have invested properties both near to them and far away. And here's what I've learned. The best investments are 1 hour away from your primary residence, 1 hour or less. Meaning, if something goes down, you need to be able to hop in your car and drive to your property. So that's about 50 miles away from where you live. But if you look at a radius area, 50-mile radius area from where you live, there are usually multiple places where you can invest that are less expensive, maybe that have competitive rates. There are people I know who do student housing, and they will buy a property near a university or things like that. So, especially for your first couple of properties that you're investing in, 50 miles away. Gotta be able to hop in a car and get to it. I have also heard of some people, let's say that they live in Washington, D.C., but their family is in Cleveland. I've heard people say, my family actually manages that property for me. I've seen that happen successfully. So if you have a family member or a friend that you trust that can hop in his or her car and go to your property when it's needed, check on your property, drive by, look at it, then that's another feasible option. I do not suggest, if you can't get there and if you don't have any family and friends or friends that can go and take a look at that property, I do not suggest that you invest there. But this is based on a lot of the conversations I've had with people. So, any other questions for this evening? I hope I said something that kind of got you sparking and thinking and, ready to move, on your dreams. I am going to put in, what do you call it? The chat here, my link, if people want to get on my calendar, talk about your portfolio, what you're looking to build, and we are able to help you with that. So I also put that in Facebook as well. Give you a minute to grab that. And, the big thing It's just understanding that you are here to build a portfolio. Being a part being a real estate investor is about building a portfolio. And how do you actually do that? What are you actually looking to build? You know, there are some people who want just multifamily. There are some people who are looking to maximize cash flow. There are some people who want to maximize their cash and their income right now. There's some people who are looking for appreciation. There are some people who are looking for tax shelters. You're a high earner and you just need to invest in some real estate for the tax shelter purposes. There are some people who just want to buy their first home and don't want to be house poor. So, what is your investment journey? That calendar app that I gave you, the link that I gave you is all about us figuring out together what your investment portfolio is going to look like, what your first property, your second property, third property, etc., is going to look like, and how we're able to work together to help you reach your goal. So, I don't see any other questions from Facebook or here on Zoom. I want to thank everybody for being here this evening, and I will see you next week. We're going to have more discussions, better discussions, and we're just going to have some fun helping you get the money you need in order to build your portfolio. Thank you so much. Thank you, Charlene. All right, everybody. Thank you, Alonzo. Take care. Have a good evening. Bye-bye.